In this new segment of Advisor Revelations, the DPL team will discuss how to evaluate new solutions and address current challenges and the strategies that can help you grow your firm and AUM.
Welcome to the Advisor Revelations podcast. I am Willie Jones, the Sales Desk Manager here at DPL Financial Partners. Today we'll be discussing multi-year guaranteed annuities, or MYGAs, and why it might make sense for retirement savers in our current environment. I would like to introduce our guest, Ross McGoodwin, who is the Regional Vice President of Member Success here at DPL Financial Partners. Ross, thanks for taking time to join us today.
Yeah, glad to be here, Willie. Really looking forward to diving into a timely conversation and looking forward to it.
Awesome. Before we start our discussion today, I do want to remind our listeners to please subscribe to this podcast on your favorite streaming app for updates. If anything we discuss today interests you, please contact a DPL consultant or visit our website at dplfp.com. Okay, Ross, tell me a little about your experience and what you do here at DPL and your role that you provide to advisors.
Yeah, absolutely. So I support a lot of our relationships across the southeast of our membership. And I've been here at DPL for 7.5 years now, which feels kind of crazy. That's a long time for DPL standards, but really any standards, that's a good amount of time. So it's been really rewarding to see the platform grow to thousands of firms and some of the largest firms across the country over the last 7.5 years. Here at DPL, I'm really tasked with managing some of our key relationships and also working in step with some of our internal consultants to provide the best possible experience to many of our member firms. So I support a lot of the relationships across the Southeast, but also some other states and national firms that may be out of other states across the country. So day to day, I'm working with our firms to understand where there's opportunities to get more value with our platform, maybe create a more valuable business, and of course, ultimately better serve their clients.
Yeah, being here 7.5 years, you've seen everything from the start of a little fledgling company to 100-employee powerhouses we're growing and all the things that go with that. So let's get into what we're really talking about today. We've seen MYGA sales skyrocket over the last couple of years. Can you share with our listeners what a MYGA is, what they do, and possibly why they're getting all this attention?
Yeah, absolutely. So a MYGA is a multi-year guaranteed annuity. So we like to say MYGA, just to abbreviate that, but it's a fixed annuity. So it's a very straightforward solution. It pays a guaranteed rate of return on a multi-year basis. So think CD alternative, that's really where it fits. And they're really popular with both advisors and clients. Clients love them because they're really straightforward. You have a guaranteed rate of return. There's no fluctuation. You know exactly what you're getting. There's not a lot of guesswork. Nothing can change at the carrier. People don't like changes, especially negative ones. So that's something that makes them really straightforward and I think really easy for both advisors and clients to talk about. Advisors love them because they, of course, provide guaranteed rate of return. So what this allows the advisor to accomplish is statement protection. So when you have negative years in the market, when you have drop in interest rates followed by increase in interest rates, you have something that can be an anchor in the portfolio, and it's not going to fluctuate. As we've discussed on previous episodes, bonds can have negative returns. 2022 was not that long ago where a lot of bond funds and bond strategies lost double digits. So a MYGA provides a multi-year guarantee on your rate of return, and that's really valuable in a financial plan and a nice thing that can really complement other fixed income and protection strategies. In terms of how they've grown in recent years, part of the reason they've grown is that on our platform, our carrier's done a great job. We've added many more carriers who support commission-free MYGAs. So the marketplace has expanded quite a bit. It's interesting, though, in 2019, one of our early podcasts, I brought on an advisor who was really new to annuities. He's a flat fee financial planner, and he was really interested in the MYGA story because he wanted to provide clients what they're asking for. Hey, can I have protection? Can I have a guaranteed rate of return? So he started utilizing MYGAs as a bond alternative and was really pleased with the results and with the client feedback. And I thought it was just really interesting that this advisor who had never really worked in the annuity space, did not come up with a broker dealer, was really gravitating towards the solution. And he ultimately was using it really as an allocation across a big part of his client base where they maybe were conservative and they were looking for something they could depend on to really balance out the rest of the portfolio. So MYGAs have grown partly because of the innovation and the awareness, but also interest rates have increased. So in recent years, they've become more competitive because interest rates drive those returns at the carrier level. And right now, they're about as strong as we've ever seen. Rates almost as high as 6% for 3 or 5 year terms. So it's a great time to take a look at them.
Yeah, and that's big. And I used to tell advisors also, don't be afraid to also put qualified money into a MYGA. Some people think all annuities have to be non-qualified, but if you're looking for that guaranteed growth, just like you would a CD, a MYGA can really fit that nature too for whatever type of money the client has.
Absolutely. Yeah. No, it could be qualified or non-qualified. Just as, of course, a refresher, if it's non-qualified, it's going to have unlimited tax deferral every year. But that doesn't mean qualified dollars don't make sense as well.
Yeah, let's talk about it. A lot going on here in 2025. And given the volatile nature of the financial markets today and where the current interest rate market stands, kind of somewhat frozen. We all thought we'd be a lot lower now, could be a lot higher. We just don't know what's going on. So why might clients consider purchasing a MYGA right now as part of the retirement planning process?
Yeah, no, it's a great question. I think when you look at the interest rate environment, we've been really competitive for quite a while, and rates have been higher than, of course, historical averages. So you've seen competitive rates in a lot of different financial instruments and the annuity industry, of course, on a wider scale. So for reference right now, some of the top paying MYGAs on our platform are paying maybe right under 6% for a 3 or a 5 year term. And that's really competitive. We think this is a great opportunity in that when you buy a MYGA or fixed annuity, you're locking in that rate for the whole term. So you could buy the contract today, and then let's say the Fed lowers rates in a few months and carriers follow suit, of course, dropping their rates as they see the returns on their general account start to fluctuate. And you don't have to worry about that. You've already bought a contract that's locked in for whatever term you pick. And on our platform, we have durations from 2 to 10 years. So you can be shorter term or longer term and lock in. So the value that I think this brings to a client is that you have a couple of things. One, you have statement protection, which is also nice for the advisor, not seeing the financial plan have the fluctuations as rates may change. You have an anchor there that's going to be consistent and going up every single day. I have some jokes with some friends where we're watching the market and we'll talk about, this stock's up or down today. And I always like to chime in and say, the MYGAs are up again. And I know that's kind of silly, but because you're not really comparing that to equities, but that behavior is true with especially retirees who are seriously watching the market every day, seeing their portfolios go up and down. And especially early this year, they're seeing the market really have an impact on their entire financial plan and their legacy values potentially. So a MYGA is going to have that daily increase, which is really important. And it's going to also have protection for when you maybe need to reinvest, right? So if you're in regular bond funds, rates, let's say they decrease, and maybe you see a return that is positive in the short term, but then you have to reinvest into something, maybe back into solutions that are in a lower interest rate environment. So that creates some risk to your returns on a go-forward basis. So being able to lock in that return for a 3, 5, 7 year period, whatever it is, allows you not to worry about the interest rate fluctuations in that part of your portfolio. You're locked in and it's competitive right now.
I would tell advisors also, no matter what type of approach you use, we talk about the 3-bucket approach, you can actually build a MYGA ladder instead of a bond ladder and be assured of those returns. And what I've learned is when you share that with a client, it's hard to put a price on exactly the peace of mind that they get knowing this is what I'm going to get. There's no fluctuation. I don't have to have the heart attacks like earlier in 2025 and like everything's going to fall apart. I know exactly what's going on. It's a consistent basis.
Yeah, for sure. And this should be fresh on people's minds. In 2022, we saw equities have a terrible year and bonds had a terrible year. And that's because right before that, rates dropped, right? There may be some positive returns in some bond funds. They sell those positions and then, oh gosh, we got to reinvest. We're in a worse rate environment. So we obviously don't know exactly what's going to happen with equities, but there could be a scenario where this happens again. And that double whammy of negative returns on both sides, it can be really detrimental to a client, especially if they are at or near retirement. So having that protection on a go-forward basis is really powerful. And that's why a lot of advisors I talk to are talking about, of course, not replacing all their fixed income with a MYGA or annuities in general. It's all about really trying to complement what you're already doing and help provide more clarity and confidence across the whole financial plan. So carving off 10, 15, 20% in a MYGA or a guaranteed return can be really valuable for clients who are entering those different phases.
Yeah, we're going to touch on that in another question I'm going to ask you. But right now, just here at DPL, one of the things is the technology that's available to advisors on our platform. They can explore annuities by goal, which will match a commission-free annuity for advisors based on the goal that they've done, and also the demographic about the client to better align the strategy they might be using. Can you just briefly go over some of the tools we have and why they'll be powerful, and even some of the anecdotal feedback you may have gotten from members that have used the tools in the past?
Yeah, absolutely. I mean, our technology is constantly changing and we're always trying to level up. So it's something that is more scalable for advisors, but something that they really want to use on a day-to-day basis. We're not building this just for us. It's meant to be for advisors. So within our websites, we of course have our annuity comparison calculators where you can compare existing annuities to our platform. We have our guaranteed income analysis tools where you can quote guaranteed income with a few clicks of a button. And then of course, we have the fixed annuity marketplace where the MYGA marketplace where you can see our rates and actually enter the durations you're looking for. And our tools will stack rank the best options. So let's say you're looking for between 3 to 5 years duration and you want to see the best options. Our tool will stack rank the products that give you the best inning accumulation value. The great, I think, next step to this evolution is, well, how do you go and buy an annuity as an advisor? If you're already working with DPL, you know that we try to take on the vast majority of the application process. And what we've evolved into is now creating a really easy process to get started. It's called the Apply Now feature. So with all of our MYGAs, if you check out our tools, and let's say you find the right option, you look through all the strategies, you find your preferred option, you're going to be able to see the carrier rating, you're going to see some of the main information that's really important, including the liquidity. And then let's say you want to move forward. We now have an Apply Now option right next to that solution so that you can immediately enter some information about the client and then start that online app request process. So I have some firms that are already utilizing this. They are actually laddering out MYGAs. So they have their team go and run the numbers. They see the option stack ranked, and then maybe they'll go and purchase a 3, 4, and 5-year MYGA, ladder them out, and they can start all those application processes straight from our website without even talking to our team. Now, we love talking to our advisors, but there's a lot of firms that they get it. They know what they're doing. They're starting to get comfortable with the MYGAs, and they want to get moving with that application process. So not only do they not have to talk to us to get the process started, we, of course, never even have to talk to the client to get the application process signed as well. We, of course, will send out the application to the client, copy on the advisor, but we're making this way more scalable than it's ever been. And that's the key, is that if a firm wants to move forward, they can get started straight from our website and have that online app request right in their system. They can share it internally with administrative support staff and anyone on their team that's signed up on our website, which is fantastic. And then they can push that app request to our team. We get it out in maybe 2 business days, and we're off and running. So that's really changed the game for some firms that say, hey, I really want to make this part of my allocation. And we've taken the steps to make that easier than ever before.
Yeah, and as you know, Ross, that's huge because insurance has always been the easiest thing to work with. And I really feel here at DPL, we're on the cutting edge to change that, especially for advisors, to make your life simpler and easier to put these solutions in place, especially when using ladders or something that straightforward. And the Apply Now feature has just really taken off, and great feedback from advisors that are using it. You mentioned something earlier about the question always comes up, because I used to deal with client directs, is how much of my portfolio should be in an annuity? And we like to preface it, we have never said, and I don't want people to think this because it's said about insurance people, all your money should be insurance products. That's kind of ridiculous. We understand what it is. Now, what's interesting is every retirement savings plans are unique, but we have some general rules to help newcomers out to be allocated into a MYGA portfolio. What have you seen for the most part, or a way for an advisor to get started to say, how should I do this?
Yeah, no, great question. Well, I think the first thing is, where do they have their assets? And we probably should have led with this a little earlier, but just so everyone knows, there's about $1 trillion CDs that are coming due in 2025. So this has already started. It's only going to continue to happen. So let's start there. Where do they have their money right now? Do they have outside annuities? Do they have money in the bank channel and CDs or other assets? I think starting there and making sure, hey, are we optimizing these assets to accomplish what you want? And if the goal is a guaranteed rate of return, then a MYGA is a great solution to maybe transfer into. And that could be from another annuity that's maybe paying a lower rate. A lot of the old fixed annuities are paying, like from decades ago, are usually paying about 3%. Well, if we can almost double the rate of return, that's super valuable. And a client maybe isn't thinking about that proactively. So existing annuities are a great place to start if that's a risk tolerance. And they already have outside annuities. The CDs that are coming due, a lot of the CDs that are offered for renewal are usually over 100 basis points lower than some of the MYGAs that we've taken a look at. Obviously that will vary. That's just a kind of a framework that we've started to notice, and it depends who you look at. But consistently, MYGAs can perform stronger than CDs with tax deferred growth. So that's a great opportunity. And then if you look at the rest of the financial plan, what are we pulling from? So I would say typically, this is maybe coming from cash or bonds. It could depend on, is the client ready to de-risk? Maybe they're not yet that heavily allocated to bonds, but it's time to make that decision. Well, this is something worth looking at. But I think the key thing is it's going to fit the role in the portfolio as a safe, dependable asset. And it really will complement what you're doing, in the fixed income space. And we've seen a lot of firms who maybe would normally look at a 60-40 portfolio with equities and bonds, maybe look at 60-20-20 or 60-30-10. And that MYGA is fitting in really nicely next to that fixed income position where maybe you can invest that a little differently or with different duration because the MYGA is there as an anchor. And that's really exciting for a lot of folks.
Definitely. That's what I've noticed too. It's really about slicing off a lot of times a part of that fixed income allocation, or once again, advisors listening, $1 trillion are coming due in CDs. That's wallet share that you can bring over and definitely put your client in a better situation.
Absolutely. Yeah. If you're not asking about, hey, do you have any money in CDs? Now's the time to ask. And I know it seems obvious, but I think sometimes clients are not always most forthcoming with how many people they're working with. I believe the stat is during a client's accumulation phase, they're on average going to work with 3 different financial advisors. And then during retirement, it usually goes down to 1 or 2. But there's a really important ask there of making sure you are getting the full picture, even if it's in the bank channel. No, we need to know about that because you might have good alternatives to bring to the table that are, of course, commission-free annuities that would still fit your business model.
Definitely. One of the biggest questions I used to get when working with clients directly is what happens at the end of my multi-year guaranteed annuity term? And what are some options available? Can you, speaking to advisors, let them know, especially think about it, the marketplace has truly changed. There's no automatic renewal for some, there's pivoting for some, and there's some just using the tool again and possibly finding some new options on the website. What are you seeing advisors do? What would you recommend?
Yeah, for sure. So it's going to vary a little bit by carrier. So some of them, let's say you go into a 4-year term, you get through the end of the 4-year term, and then you'll get a renewal rate, an offer letter that says, hey, if you'd like to renew for another 4-year term, here are the current rates we can offer. And for some carriers, it's the same as, of course, the new money rates. It's as if you just went back to them and said, I'd like to buy another 4-year MYGA. So sometimes just renewing back in the same term as an option. Other carriers may offer multiple terms. So at the end, let's say you pick 3 years, at the end of 3 years, then you may get an offer letter that has 3, 5, and 7-year options. And you can decide at the current carrier, one of these makes sense. And then some of our carriers have a really nice feature where it's basically a 1-year fixed account that's liquid. And it may not be as high of a rate as what they would offer for a 3 or 5-year guarantee, but it has that flexibility where there's absolutely no really strings attached, and it can be a nice, simple rate that's just on a 1-year guaranteed basis. So some people really like that. Just they want to be really nimble. And then finally, as you just brought up, maybe it makes sense to shop it around again. And that's where our technology is key. And we, of course, work with our advisors to say, hey, once it reaches maturity, once it becomes liquid, if it maybe is a product with some illiquidity, at that point in time, you can reevaluate and see what's competitive, because it may be that at the end of the term that a new carrier makes sense, or maybe a shorter duration makes sense, or maybe the opposite. Maybe you went in for 4 years and now like, heck, let's lock in for 7. We really like where we're at right now.
What about goals changing too? What about that? That could be a big one.
Absolutely. Yeah. At the end of the term, maybe you bought it for guaranteed rate of return. And I've had some folks actually move to a fixed index annuity and say, okay, we're okay with a little more fluctuation. We're not going to experience downside returns with a fixed index annuity, only positives. But instead of just a guaranteed rate, We had an individual that said, we really want to get S&P exposure that's double digits with a floor of 0. And that sort of fits a different risk tolerance, but it's very close to a MYGA. And that was appropriate for that specific client. So I think at that point, it's just a natural opportunity to revisit their goals, what they're looking for. Plenty of people re-up with the same term or a MYGA. Others will actually pivot to something different that fits their goals or maybe produces lifetime income. Don't forget about that. And then finally, if their goals they completely change and they just want to surrender it at the end of the term, you can do that. Or if it's non-qualified, you want to maintain a taxable gain, move to an ultra low cost variable annuity and be able to continue deferring taxes. But now the advisor can manage with maybe 100 investment options and have a ton of flexibility to basically have like a tax-free brokerage account in that it has the annuity tax wrapper, a lot of funds, and you're really just trying to grow the assets. So the great news is that there's tons of options once you get to the end.
That's what I was going to say. The true thing is there's flexibility, and we here at DPL are going to help you with that flexibility, whether it's income, pivoting to a different solution, pivoting to what I would call turning non-qualified money, almost like it's IRA money in a tax-deferred account with tons of investment options. We're here to help with all of that. Ross, I just want to thank you for your time. I think it's been a great conversation, especially once again, advisors, $1 trillion is sitting out there for you to grab on. Any thoughts or closing comments you'd like to share?
Yeah, I think just one additional thought. Many advisors ask about their fee billing options and, talk to the DPL team and your consultant about the options. MYGAs oftentimes will have fee billing that needs to occur from an outside asset, but that's where our technology is key. You can see the daily values through our website on the DPL e-portal, and then we integrate with a lot of the top platforms in the industry in terms of performance reporting software with a daily feed as well. So you can see it there on a go-forward basis and also handle billing that way. And on that note as well, if you really value principal protection and you have a strong inclination that you want to pull your fee from the contract, some MYGAs will allow that, but then fixed index annuities may offer fixed accounts and of course, index exposure that will have more fee billing flexibility. So at the end of the day, we always say this, we don't have a dog in the fight in terms of carrier or product type. We only want to find what's the right fit for the end client and of course, what fits your business and how you want to operate. So it's important just to ask the question of obviously, well, for us, ask the question, what you're trying to accomplish, but then for you to share what you're looking for and don't hesitate to ask about anything regarding the product, regarding ease of use, website experience, regarding fee billing capabilities. We want to make sure that's all crystal clear. So when in doubt, pick up the phone, call us, shoot us an email. We're here to help.
Yeah, tell again, our member firms and future member firms, we are consultants and we're going to do what's right. We feel that we have that fiduciary obligation to help your client achieve their goals. Ross, just want to thank you again. And I want to thank everyone that's listening to this podcast for joining us today. And once again, feel free to connect at dplfp.com. Please subscribe. There's lots more episodes to listen to, and have a great day.
Thanks for listening. To hear more advisor revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.